Hi, I'm Brian Pollak, partner and portfolio manager at Evercore Wealth Management and chair of our investment policy committee. There's a lot for investors to think about at the start of the second quarter of the 21st century. The first was certainly eventful, with multiple once-in-a-generation events in a single generation, including the dot-com bust, 9/11, the record losses of the great financial crisis, and of course, the pandemic. Yet those first 25 years turned out to be one of the greatest, albeit uneven, wealth creation periods in U.S. history. 1 in 5 Americans is now a millionaire. There are close to 1 million deca-millionaires. So now what? Here are brief answers to 6 pressing questions as we enter 2026. For our latest report, please contact us. We look forward to discussing the markets with you in the context of your own financial goals. Most geopolitical uncertainties generally don't weigh long on the market, as investors tend to differentiate headline risk from economic risk that could affect earnings growth. Comments by President Trump that the United States will run Venezuela and needs Greenland have so far not affected markets adversely, nor have the ongoing conflicts in the Middle East and Ukraine. This is a subject we address often, so again, please don't hesitate to contact us for more information. Domestic fiscal and monetary policy is more meaningful in this context, and the outlook is mixed. The administration's tariff threats have come to be seen by investors as negotiable and incremental. Broader policy is still supportive of the markets. Tax rebates and deregulation, mostly prominent in the energy and financial services industries, should foster economic growth. DOGE made no real impact on fiscal spending, and additional Fed easing should be supportive, although if Fed independence is called into question, it could backfire. Debt levels relative to GDP are massive around the world, not just in the United States. But the U.S. debt load is more prevalent at the government level, and consumer and corporate debt-to-income ratios are relatively normal. That makes a traditional credit crisis unlikely. No, but the U.S. advantage is narrowing as government debt and intervention in the corporate sector rises, and the dollar, while still the world's reserve currency, loses value. And China is catching up quickly across key technology sectors, including AI, electric and autonomous vehicles, and even semiconductors. We are increasing our exposure to international stocks, notably in Europe and Japan, but remain overweight the U.S. markets. We need to distinguish between a bubble with fundamental underpinnings and a speculative mania. Signs of an AI bubble are certainly present, including circular financing, extreme valuations, and increasing debt loads to finance AI infrastructure. But a mania, which is characterized by more extreme speculation far exceeding intrinsic value, is less in evidence in our opinion. AI technology is real and adoption is broadening. AI-related CapEx is already a meaningful contributor to U.S. GDP growth and infrastructure. As AI use cases expand, prudent investors might consider this an opportunity to invest in companies with current and significant profits and relatively low debt and valuations. Lower income and younger Americans remain constrained by still elevated prices, and their debt loads are rising. But high-income households, notably led by baby boomers, are benefiting disproportionately from the wealth effect of rising home and equity prices. They remain confident consumers. The labor pool itself is stagnating, partially due to lower net immigration, leaving supply and demand of labor in equilibrium. If this holds, we could see a strengthening in real wages. We think a disciplined, diversified approach remains the best defense against volatility and uncertainty. Defensive assets, including cash, treasuries, and municipal bonds, still have yields above the rate of inflation and can serve as ballast in a balanced portfolio. Credit spreads have narrowed, but we continue to find corporate credit, particularly BDCs, and securitized credit attractive. And where appropriate, we recommend increasing diversification through stores of value such as gold and even Bitcoin. Growth assets remain dominant in most client portfolios, and despite rich U.S. equity valuations and concentrated market, U.S. earnings growth is expected to be robust, providing a basis for solid market returns. As mentioned, we are increasing our allocation to international equities while retaining exposure to big tech and companies in the broader market, which should benefit from enhanced productivity through AI and other advances. Private assets are an increasingly significant allocation in many of our client portfolios. In private equity, we are currently focused on buyout and growth opportunities, investing with managers we believe will be able to add operational value and generate attractive long-term return streams that can enhance risk-adjusted returns in portfolios with a reasonably long time horizon. So, a lot to think about in what is sure to be another eventful year. We remain focused on building robust client portfolios able to withstand a range of economic and market conditions in the context of each client's long-term financial goals.